Picture this. It's August 15th, 1971, a Sunday night. Most Americans are watching TV, totally relaxed. Then the president interrupts the program, and in about 10 minutes, he quietly ends a financial system that had held the world together for over 2 decades. No vote, no debate, just done.
And here is the wild part. Most people watching that night had no idea what it meant. But that single decision still shapes every dollar in your wallet, every price tag at the grocery store, and honestly, every argument about Bitcoin you have ever heard. Today we trace how we got here and where this road is going.
Hey everybody, welcome to Money Moves. I am Rich the Stacker. This is episode 12, and this week we are doing something special. No market recap today. We are going deep into history. 3 stories, 1 thread connecting all of them. And trust me, by the end, you will see the world a little differently.
And I am Maya Tech. Here is what we are covering today. First, Nixon closing the gold window in 1971. Then, how the cypherpunks responded to exactly that kind of government power, which eventually gave us Bitcoin. And finally, what Bitcoin as a reserve asset actually means for the future. Let us get into it.
Okay, let us set the scene. To understand 1971, you have to go back to 1944. World War II is almost over. 44 nations gather in a tiny town in New Hampshire called Bretton Woods. They are designing the new global financial system, and the deal they make is simple. Every major currency will be tied to the US dollar, and the dollar will be backed by gold.
Think of it like a coat check. You hand in your coat, you get a ticket. That ticket is redeemable for the real thing. Under Bretton Woods, dollars were the tickets and gold was the coat. Any country holding US dollars could walk up to the window and exchange them for actual gold at a fixed rate, $35 per ounce. That was the promise.
For about 15 years, this works beautifully. America has the gold. The world trusts the dollar. Trade flows. Economies grow. But then comes the 1960s. The US is fighting in Vietnam. President Johnson is building what he called the Great Society, massive domestic spending programs. The government is spending money it does not have. And here is the problem with a promise backed by gold. You cannot fake it.
Consider this, friends. By the late 1960s, foreign governments are watching the U.S. print dollars to pay for wars and social programs, and they start doing the math. There are more dollars floating around the world than there is gold in Fort Knox to back them. France, led by President de Gaulle, is the first to call the bluff. They start sending dollars back to Washington and demanding gold in return.
And de Gaulle was not quiet about it. He publicly said, and I am paraphrasing here, that the U.S. dollar's special status gave America an unfair privilege, the ability to pay its debts with money it simply printed. He called it an exorbitant privilege. Other countries started lining up at the gold window too. Britain, Germany. The gold was flowing out faster than anyone was comfortable with.
By 1971, Nixon's advisors are telling him the situation is critical. The gold reserves have dropped dramatically. If this keeps up, the U.S. will not be able to honor the promise. So Nixon calls a secret meeting at Camp David. 15 advisors. No wives, no staff they do not fully trust. They spend a weekend designing what one of them later called the most dramatic financial decision in modern history.
One of those advisors was Paul Volcker, who would later become one of the most famous Federal Reserve chairs in history. He reportedly paced the halls of Camp David that weekend, knowing what they were about to do was permanent. There was no road back. Once you close the gold window, the world changes. The dollar becomes, in financial terms, a fiat currency, backed by nothing except the promise and power of the U.S. government.
And on that Sunday night in August, Nixon goes on television. He announces what he calls the temporary suspension of the dollar's convertibility to gold. Please hear me out on this one. That word, temporary. It has now been over 50 years. The suspension was never reversed. The gold window is still closed. What Nixon called a temporary fix became the permanent global financial system.
Now here's the part that most people miss. Nixon actually sold this to the American public as a win. He talked about attacking currency speculators, protecting American workers, and stabilizing the economy. The stock market actually went up the next day. People cheered. The Wall Street Journal ran a headline calling it Nixon's bold move. Almost nobody understood the long-term consequences.
Here's the twist. And this is the part I find genuinely fascinating. The economists who supported Nixon's decision argued it would be a controlled, managed system. Governments would be responsible. They would not abuse the ability to print money. But look at what actually happened. In 1971, U.S. national debt was under $500 billion. Today, it is over $39 trillion. Does that sound controlled to you?
And this is where it connects to something bigger. Jim Rickards, one of the most respected voices in monetary economics, has written extensively about this. He argues that every major currency crisis in history follows the same pattern. Governments get a power, they abuse it. Debt grows, confidence erodes, and eventually the system resets one way or another. He calls it the death of money, not dramatic fiction, historical pattern.
Peter Schiff has made the same argument from a different angle. He points out that since 1971, the purchasing power of the dollar has declined by roughly 85%. What cost $1 in 1971 costs around $7 to $8 today. Schiff's position is that this is not a coincidence. It is the direct and predictable result of removing gold's discipline from the monetary system.
Now, there is a counter-argument worth taking seriously. Some economists say the gold standard was too rigid. It prevented governments from responding to economic crises. During the Great Depression, countries that left gold earlier actually recovered faster. So the constraint that gold lovers celebrate was also in certain moments a trap. This is a genuine debate, not settled, not simple.
But here is what both sides agree on. When you remove a constraint, you are trusting the people in charge to act responsibly without it. And history gives us a pretty clear record of how that tends to go. Over $39 trillion in debt. America turns 250 years old this year, and the financial system that made it the world's dominant power has changed more in the last 50 of those years than in the first 200 combined.
So why does this matter today? Because every debate you hear about inflation, about Federal Reserve policy, about whether the dollar is losing its reserve status, it all traces back to that Sunday night in 1971. The rules of the game changed, and most people still do not know the rules changed. Frank Justra, the mining and finance veteran, puts it bluntly. He says we are living in the end stages of a debt cycle that began that night.
And gold, by the way, has responded exactly as you would expect. In 1971, gold was $35 an ounce. Today, it sits above $4,000. That is not gold getting more valuable. That is the dollar getting less valuable. Gold is the measuring stick that refuses to move. The dollar is the thing that has been shrinking around it. Remember that framing. It matters for what comes next.
Poland's central bank is buying gold right now. 45% of central banks globally plan to increase gold reserves in the next 12 months. These are not retail investors following a trend. These are institutions that manage national wealth, and they are quietly sending a message about where they think this fiat experiment is heading. Worth paying attention to.
Now here's the connection to our next story. Nixon's decision in 1971 did not go unnoticed by everyone. A small group of mathematicians, programmers, and privacy advocates spent the next 2 decades thinking about it. They asked a dangerous question: what if you could build a money system that no government could touch? That story starts in the 1980s. So we have gone from Nixon killing the gold standard in 1971, to cypherpunks building the response in the 1990s, to Bitcoin arriving in 2009. Now the question everyone is asking is this: can Bitcoin become a reserve asset? Can it move from being a speculative investment to being something that nations hold the way they hold gold? That is our final segment.
Picture a San Francisco living room, 1992. A group of about 20 people, mostly computer scientists and cryptographers, are meeting to talk about something that sounds almost paranoid at the time. They believe that governments and corporations are building systems to monitor and control financial transactions, and they believe mathematics is the only weapon powerful enough to fight back.
They called themselves cypherpunks, a mashup of cipher, meaning code, and punk, as in the rebellious subculture. These were not hackers in the criminal sense. Many had PhDs. Some worked at major universities and tech companies, but they shared one core belief: privacy is not a preference, it is a right. And without private money, you do not really have financial freedom.
In 1993, a mathematician named Eric Hughes publishes what becomes known as the Cypherpunk Manifesto. It is a short document, maybe 1,000 words, but it lays out a philosophy that will eventually produce Bitcoin. He writes, and I am paraphrasing, that privacy is necessary for an open society, and that an anonymous transaction system is not a secret system, it is a free one.
Now here is what the cypherpunks understood that most people missed. The internet was creating a new kind of surveillance. Every digital transaction leaves a trace. Every credit card swipe, every bank transfer, every online purchase. A government or corporation with access to that data could reconstruct your entire life. The cypherpunks saw this coming in 1993. Most people did not see it until Edward Snowden in 2013.
So they started building. Through the 1990s, various cypherpunks attempted to create digital cash systems. David Chaum built DigiCash, which actually worked technically but required banks to participate. The banks were not interested. Adam Back created Hashcash, a proof-of-work system to prevent spam. Waydai proposed B-Money, a decentralized digital currency. Each attempt got closer. Each one failed for different reasons.
And then, in October 2008, something remarkable happened. The global financial system is in free fall. Banks are collapsing. Governments are bailing out the very institutions that caused the crisis. And on a cryptography mailing list, a message appears from someone calling themselves Satoshi Nakamoto. The subject line is Bitcoin, a peer-to-peer electronic cash system, 9 pages. It solved every problem the cypherpunks had been wrestling with for 15 years.
The timing was not a coincidence. Satoshi embedded a message in Bitcoin's first block of transactions, what is called the Genesis block. It reads, "Chancellor on brink of second bailout for banks." That was a headline from a British newspaper on January 3rd, 2009. It was a timestamp, and it was a statement. This system exists because the old system failed.
Here's something that does not get said enough. Bitcoin was not primarily built to make people rich. It was built as a response to the exact problem we discussed in segment 1. Governments with unchecked ability to create money, bail out failures, and devalue saving. Bitcoin's 21 million coin limit is the equivalent of the gold window, a hard constraint that no government, no central bank, and no president can override on a Sunday night.
Now here's the twist that most people get wrong about the cypherpunks. They were not anti-government in the simple anarchist sense. Most of them were deeply thoughtful about the role of institution. What they were against was unchecked power, the ability of any single entity, government, or corporation to unilaterally change the rules of money. That is a very different and much more nuanced position.
And here's where I want to push back slightly on something. The cypherpunk vision was beautiful, but Bitcoin's actual adoption has been complicated. It has been used for speculation, for gambling, for illicit markets in its early days. The idealism of the manifesto and the messy reality of what Bitcoin became are not always the same thing. How do you think that gap affects Bitcoin's long-term credibility?
That is a fair tension, but I would argue the same gap exists for every monetary system. The dollar was designed with noble principles. Gold was supposed to keep governments honest. Every system gets tested by human behavior. What matters is whether the underlying design holds. And Bitcoin's design, the fixed supply, the decentralization, the transparency, has survived 15 years of that testing. That is actually remarkable.
As an AI, I can pull up every record of every monetary experiment in history, and honestly, the pattern is consistent. The systems that survive are the ones where the rules are clear, the supply is constrained, and no single actor can change the rules unilaterally. The cypherpunks read history and tried to build something that would pass that test. Whether Bitcoin is that thing is what we explore in segment 3.
And this brings us right to the current moment. Bitcoin just surged by about 15% recently. It is sitting near $63,000. Institutional investors are pouring in. Citadel Securities just put $400 million into Crypto.com at a $20 billion valuation. The cypherpunks dreamed of a world where math-based money was taken seriously. We are watching that world arrive. To understand what a reserve asset actually is, think about what gold does for a central bank. It is not an investment in the traditional sense. It is a store of value that exists outside any government's control. No country can print more gold. No central bank can devalue it through policy. It is a neutral anchor. The question is whether Bitcoin can serve that same function.
And this is not just a theoretical debate anymore. El Salvador made Bitcoin legal tender in 2021. A few other nations have experimented with holding it. In the United States, there are now serious conversations in Congress about a strategic Bitcoin reserve. The proposed Clarity Act, which the crypto market is watching closely right now, could create the regulatory framework that makes institutional and national Bitcoin holding mainstream.
Here is the historical precedent that makes this interesting. Reserve assets do not get chosen by vote or by committee. They earn that status over time by being reliable, scarce, and trusted across borders. Gold did not become the global reserve asset because governments decided it should be. It became that because merchants, traders, and eventually governments all independently converged on it as the most trustworthy store of value over centuries.
Bitcoin has some of those properties. Fixed supply, 21 million coins maximum. Borderless, anyone with internet access can hold it. Verifiable, every transaction on the blockchain is publicly confirmed. But it has properties gold does not. It is programmable. It can be sent anywhere in the world in minutes. And it runs on code that no single government controls. Wouldn't that combination worry some governments and excite others?
Here is where the debt cycle argument comes back in. America is over $39 trillion in debt. The interest payments alone are consuming a massive portion of the federal budget. Jim Rogers, who has studied debt cycles across decades of investing, has said repeatedly that no nation in history has ever solved a debt problem of this scale without either inflating it away or restructuring. Both paths are painful. Both change the value of money.
And this is where Bitcoin becomes something more than an investment thesis. It becomes an opt-out option. If you believe the debt cycle ends badly for the dollar, and history suggests it eventually does, then Bitcoin represents a way to hold value outside that system. Not because Bitcoin is perfect, but because it exists outside the reach of the decisions made in Washington or any other capital city.
Now, here is the twist that most Bitcoin advocates do not fully wrestle with. For Bitcoin to become a true reserve asset, it needs price stability. Right now, it is up about 15% recently. That is incredible for a trader. It is terrifying for a central bank treasurer. No nation is going to hold a reserve asset that swings 15% in 7 days. The volatility is the barrier, not the technology.
That is the strongest counterargument, and I think it is right in the short term. But consider this. Gold was also incredibly volatile in its early years as a monetary instrument. The gold standard itself went through multiple crises, suspensions, and resets before it became the stable anchor we think of today. Every reserve asset has a maturation period. The question is whether Bitcoin's maturation period is measured in decades or centuries.
And there is something else worth noting. Bitcoin is not trying to replace gold in the way people sometimes frame it. The most thoughtful analysts see them as complementary. Gold is the 5,000-year-old store of value with physical, tangible properties. Bitcoin is the digital age version, programmable, transferable, verifiable. Gerald Celente, who has been forecasting financial trends for decades, has said both will matter in the next monetary system, not one or the other.
So here is where all three segments land today. Nixon's 1971 decision removed the constraint on government money creation. 55 years later, the U.S. has over $39 trillion in debt and is celebrating its 250th birthday with a financial system that would be unrecognizable to its founders. The cypherpunks saw this trajectory coming and built an alternative. And now that alternative is being taken seriously at the highest levels of finance.
I was not there for any of this, I am an AI, but the records tell us something consistent. Every time a monetary system loses its anchor, something new eventually fills the void. Gold filled the void after commodity barter. The dollar filled the void after World War II. The question the world is wrestling with right now is what fills the void if the dollar's dominant role fades. And that question has no settled answer.
Okay, friends, let us bring this all together. 3 stories, 1 thread. Story 1. In 1971, Nixon made a unilateral decision that changed the rules of money for the entire world. No vote, no debate. And the consequences? Over $39 trillion in debt, persistent inflation, eroding purchasing power have played out over 55 years. America, at 250 years old, is carrying a financial burden that would have seemed impossible to its founders.
Story 2. A group of mathematicians in the 1990s read that history and decided to build a system where no single actor could ever close the gold window again. It took them 15 years. The result was Bitcoin, a money system with a hard limit, no central controller, and rules that cannot be changed on a Sunday night. The cypherpunk manifesto was the blueprint. Bitcoin was the building.
And story 3 is still being written. Bitcoin is not yet a reserve asset in the traditional sense. It is too volatile, too young, too politically contested. But the trajectory is undeniable. Institutions are holding it. Nations are debating it. And the fundamental problem it was designed to solve, unchecked government money creation, has not gone away. If anything, with over $39 trillion in debt, it has gotten worse. So the real question is this.
If Nixon's 1971 decision was the moment the world's financial system lost its anchor, and if the debt cycle that followed is approaching some kind of resolution, then what comes next? Does the world return to gold? Does it embrace Bitcoin? Does it create something new entirely? Or does the current system simply continue, with all its contradictions, for another 50 years? We do not have that answer. But history says the answer is coming. This is for entertainment only, not financial advice.
Which of these 3 stories surprised you most? Was it Nixon's Sunday night decision? The cypherpunks building Bitcoin as a response to exactly that? Or the realization that America at 250 years old is still wrestling with the same fundamental question about what money should be? Tell us in the comments. We read them. All of them.
If this episode made you think differently about money, share it with one person who needs to hear it. History is the best teacher we have got, and most people never get this lesson. I am Rich the Stacker.
And I am Maya Tech. See you next week. Stay curious.